Good morning, everyone. Welcome to the meeting today. I'm Neil Himmelstein, for those of you who don't know me, president of Main Street Planning Group. We're a full-service, independent wholesaler of fixed insurance products, specializing in life insurance and long-term care, disability, and annuities. And my co-host, Larry Scherer of Scherer and Purdell, is an estate planning attorney and business succession attorney with a law practice in Garden City. And we work very closely together, back and forth with insurance issues, estate issues, and very helpful to be part of Main Street's team in helping clients and agents succeed. So with that, I just want to tell you that I'm deeply committed to the life insurance industry and passionate about the industry, to the point that I'm going to be starting some legislation with New York State, with the backing of NAIFA, on a long-term care initiative. We're in danger of having just one long-term carrier at this point, with impending price increases and no partnership plans. And there's some things being done in other states that we're going to be putting in front of New York State. So if anybody wants to join me in my crusade, I'm very happy to have people with me to fight the fight, because you can't win a war with one person. You need an army. So anybody wanting to join in my efforts, I appreciate it. Today we're going to talk about planning opportunities for 2021, and understand that there's a major tax overhaul that's going to be talked about tonight. And actually, at 5 a.m. this morning, Larry Scherer was up reading all the new provisions. So some of the things in the presentation will be altered as up-to-the-minute news as to what the government is planning to do. But the most beautiful thing in the world is that we have the only product protected from taxation from the IRS, which makes it quite the planning opportunity today and for the next few years, that the life insurance industry is going to go through a big boom, and hopefully we'll all be part of it. Okay, so with that, I'm going to start the presentation. Oh, I didn't hit my share screen, did I?
No.
Okay, here we go. Hold on a second. Share screen. Can everybody see this?
No, not on yet.
Not yet.
Okay, there's a way of doing this. Okay. This is the one we want to share. Hit share. There we go. Everybody can see that?
And
Yep,
we're in.
And we're in. Okay. Let me okay. So 2021 post-election planning opportunities is the name of our discussion. And first off, the biggest change that kind of happened in the life insurance industry recently is this IRC 7702 changes. For those of you who don't know what it is, I'm not going to spend a lot of time on it. All it's doing is allowing a lot more premium to come in without triggering MEC treatment. So all the insurance carriers are busily changing their product to accommodate this. This is a win-win-win for the consumer, and for any accumulation life products, premium financing, you can load a lot more money without the product MECing. So you're going to see product change.
Retroactive to existing policies or not?
Oh yeah, so for instance, New York Life, Mass Mutual are adapting their whole life policies so that you could put more money in. Existing policies that are already there are not going to change.
Okay.
This is moving forward. They're going to amend the new policies to allow more cash accumulation without it. So that's already started. Okay, we have a lot of changes that have been proposed, and what to extent and how quickly will they be done. Budget reconciliation makes changes possible, but slim majority may require compromise. We all know that. Listen, there are big spending plans. With big spending plans, they have to counteract it with taxes. The wealthy is going to be under siege. Question. So these were the proposals before I started this morning, and these are not on the table yet. But the original proposals where they were going to reduce the estate tax exemption down to 3.5 million. Now, 2026, the sunset is coming to where it goes down to what, Larry, 6 million?
It's going to be approximately 6 million, yes.
Okay, this was not brought up in tonight's meeting, is not going to be brought up yet. They do know it's sunsetting. We thought there was going to be a decoupling of the federal, state, and gift taxes, imposing a 1 million gift time tax limit. And why is that important? Because if you want to do gifting, you want to do it now. Now, that is not in tonight's proposal either. Okay, but again, it's on the horizon. What is on the horizon is a big increase in, well, Larry, you can go through what's on the horizon from this morning.
Yeah, well, I think we're going to do that at the end unless you want me to.
Okay, we could do that at the end. But anyhow, there's going to be a step up in basis, what they're proposing, not an elimination, but a limitation to step up in basis. And there's going to be a limitation on 1031 exchanges, limiting 500,000 is what the proposal is of the gain to do a 1031 exchange. So all these things are happening. Now, also, the applicable federal AFR rates remain historically low. But for how long, we don't know. And we're going to talk about what that means and where that is in relevance. So, whoops. Well, basically, if your client hasn't done any estate planning or anything else in the past, now is the time to do it. Now is the time to talk to them about their wills, estate planning, gifting, all these things. Talk to Larry. If they haven't talked to their own attorney, you need to bring this up to their clients because they need to prepare for all these changes. Corporate tax rates are looking to go up. Obviously, they're looking to go after the rich on capital gains. For any of you guys who are investment guys like Donnie Schulman, and they're going to start seeing big, capital gains. Now's the time to plan because, we do have a protected product called life insurance. So, can trustee optimize trust-owned assets with life insurance? Compare gift and trust invest. Okay, we're going to talk about this. Favorable income tax year. What's the best ROI in someone's estate? Okay, is it the best ROI, the best return on investment is life insurance. It's the most leverage you can get in a tax-free world where the money can grow tax-deferred, and if you put it in a proper life insurance trust, can be estate tax-free as well. So there's no better return. You could talk about Roth IRAs, which technically they can change some of the taxation on that. They've changed some of the taxation on the Secure Act. We're going to talk about that, where they're going to force income out and force taxation in 10 years. There are exceptions to that. We're going to review that. But that's what we're talking about here. Stretch IRA with the Secure Act, which they haven't touched yet, but they're going to revise it a little bit from what I heard, is now on beneficiaries, except with some exceptions. They're going to have to take out the money, not spousal, for the next 10 years. Okay? There are exceptions there. What does that mean is that could be detrimental to the beneficiaries, where they're going to have to pay not only the estate tax on the IRA, but the income tax. Okay? There's going to be an increased estate and income tax, we believe. Gifting limits, which didn't happen. And let's talk about the cost of waiting. The products are changing very quickly. The product may not be around anymore. We've seen in New York, John Hancock leave part of his portfolio. We've seen other companies leave the state of New York. We see products changing because of 7702. So by the time a client makes their decision, oh, I want a guaranteed UL. Well, there may not be any guaranteed ULs anymore. So, you need to plan now. What's the age and health going to be like? Forget about next year. How about in 6 months or in 2 months? Okay. We don't know when our impending health is going to change. It can change at an instant, like anything else. And how much will the price change over time? We're in such a historically low interest rate environment that insurance companies are having a difficult time making the kind of profits they were making, particularly in New York because of reserves and everything else. So what do? They get rid of products and they raise the price. So there's a big cost of waiting right now. Now is the time to work. Plan gifting strategies. Establish the wills and trusts now. Put them in place. And I'm looking at Paul because Paul Feigenbaum had a client that wants to put $3 million. He's not sure whether he wants to buy the insurance today or tomorrow. So we're recommending he set up his trust, okay? And at least put the money there. And maybe we could do a wait and see attitude, but fund it have some life insurance in place, even if you place term or whatever you need to do, have it in place, fund it later, or you can loan the money into your trust, okay? And we can talk about that a bit. Leverage a low interest rate, use finance as a wait and see alternative to gifting. Okay, if I don't want to make an outright gift, I can loan the money to the trust, get interest back to me from the trust, only charge the AFR rate, which we'll go through, which is extremely low. And, it's a good wait and see kind of idea. Discuss long-term care. I said it in the beginning. I got to say it again. I got to say it every day. Long-term care is the pending disaster that's ever present. We have such pressure on product right now that if your clients are on the fence, now is the time to buy it. We have one carrier left in the brokerage world, which is Mutual of Omaha on the traditional standalone. They have filed with New York State and New Jersey price increases. I have an email coming out showing the price increases around the country on this product. And if you're the only game in town, you can raise the price to whatever you want, and you can be very selective, okay, which they have been, but even more selective, particularly on dementia or family history of dementia issues. Other carriers are starting to say, we're not going to issue insurance anymore. So if you have anybody on the fence, you got to discuss it now. Very important.
Neil, just want to point out that while everyone was sitting around at home in the beginning of the COVID, New York State got together and they passed laws that were very detrimental to the people who are elderly trying to protect their assets. So we used to have a 1 month look back period before you could apply for in-community or in-your-home Medicaid. They've extended that to 30 months, 2.5 years. That's half of what it takes to hide your assets from a nursing home. And it's something that just came up. So people have to do that planning. Long-term care insurance is a great stopgap measure, but they got to get to that planning. There are some extensions that went out, and just last week they extended the implementation of that new 30-month rule all the way to January 1st of this coming year for those people who are ill right now.
Excellent. Thank you. So financing as an alternative to gifting. We talked a little bit about gifting. Let's talk about financing.
Yes.
Accessibility, willingness to make a gift. Have they already made gifts? Are they using their lifetime exemption? Do they have existing trusts? If so, what assets do these trusts own? Are they grantor or non-grantor trusts? These are things that you need to review with your clients. We have clients that are attorneys that think they know what they're doing in setting up their life insurance trust. Again, I'm looking at somebody else. If they don't set it up properly, they'll end up kind of screwing themselves. Excuse my language. That's a problem. If gifting isn't around, leverage low interest rates. Okay. How much is the cash they have on hand? What are the assets they own? Are there any restrictions that would prevent the client from transferring these assets to a trust? So potential solutions, private split dollar, private finance. Now, this is called a lot of different things. The latest is they're talking about what they call SLATs. What they are is really private split dollar, where you can set up the trust And the spousal, they call it spousal, LAT. What's the spousal? What is that?
Limited access trust.
Thank you. Spousal limited access trust. Basically, you can set up let's say a seconded I policy and put a lot of cash in it, and the spouse can have access for emergencies and whatnot by setting up the proper trust work. So this has always been a dilemma, and helps handle some of the what ifs, and it's very sophisticated planning. But when you start, all those clients that said, I don't have to worry about estate taxes, guess what? You're gonna have to worry about estate taxes. You're gonna worry about long-term capital gains. You have one protected product out there. It's called life insurance. Now we gotta be creative, okay?
Just to point out, when we're dealing with SLATs, you have to worry about whether you overfund them. So there has to be an escape hatch in them, just in case the gift tax exclusion does drop.
Right. These are the AFR rates. We talked about that. If you loan the money into a trust, and this is the history. They're still at a all-time low, although they've crept up some. But you look at where they are in January 2021, 0.6%. So this is great, good stuff. So this is what they call wait and see loan, where private financing, where the grantor will loan the money to the trust. The trust will pay that interest and at the AFR rate, okay? The trust will pay for the premiums for a life policy. Death benefit goes back to the trust. This way, that money is still accessible. It's just loaned, and then loans could be forgiven later or not. So it gives the client flexibility. This goes through all that in detail. All right. The other thing that I've done a lot of seminars is on premium financing strategy. The client will establish an irrevocable life insurance. The ILIT borrows the money. The way we set them up, it's not borrowed personally, it's borrowed by the ILIT. Therefore, the client is not personally liable for making those payments. There's a third party that finances a policy. The client pays interest to the trust. That's the only gifting that's done. That's how you can minimize your gifting a great deal and leverage other people's money to buy a lot of life insurance. For those people who are heavily invested in real estate or illiquid, but still have, things they can post and don't want to use their current assets, this is a great solution to that strategy. I'm sorry, this slide got missed. This was the private financing asset sale option. These slides got reversed. I apologize. Everybody's going to get a copy of this after the presentation. I'm hitting you with a lot of stuff. There's a lot of stuff to cover. Okay. Income tax planning. Okay, income tax rates above 400,000. They're looking to increase up to 39.6. Larry, is that still in today's proposal?
Yes.
Okay. Long-term capital gains and dividends taxes ordinary income above $1 million. Is that in today's proposal?
Yes, I'm not sure what the number was, whether it was 1 million or 400,000, but I think it is.
Right.
I think it's still 1 million.
Okay, the Secure Act has eliminated the stretch IRAs. We talked about that. IRAs, 401ks, qualified income. They're subject to estate tax, okay, and income tax on distribution. So potentially that $1 million sitting in an IRA or 401k can be severely taxed moving forward. So that's where we have some strategies to whether use an immediate annuity and buy life insurance with it, but you really got to look at your qualified money of your clients and plan. There's also potential opportunities for charitable planning right now, tremendous ones, and tax diversification with permanent life insurance, and there's other living benefits such as long-term care that we discussed.
Just to go back, the IRA has always been taxed both for income tax and for estate tax. The difference is now just the speed at which you have to withdraw the funds.
Right. So we talked about accumulation situations. So life insurance still grows, tax deferred, take out money tax-free. There's no restrictions on how much you can put in. There's no penalties for early access to cash, and a tax-free death benefit for long-term care costs for if a long-term care rider is added to the policy. It's a home run with section 7702. We can now put in a lot more money and protect it for businesses and individuals. So for longevity purposes, potential cash value can supplement retirement income when primary assets are spent down. Death benefit can diminish assets for surviving spouse and dependents. Long-term care, optional riders may be available to accelerate the death benefit to help pay for those potential expenses. Sequence of return risk, potential cash value can provide alternative for potential supplemental income when the market is down. Withdrawal rate risk, cash value can provide additional income to offset inflationary spending and taxes. Cash value can be accessed income tax-free and not reportable as income. That's huge.
Wow. Okay.
Now, I'm going to turn it over to Larry, who's going to talk a little bit more about some of the Biden proposals that will be done tonight. Larry was up at 5 a.m. for those of you who didn't realize.
When you say I was up at 5 a.m., I didn't actually know about the 5 a.m. bill being floated until 7 o'clock. So I've been analyzing since then. But let's go to share screen. And do we have it?
There you go.
No,
wrong one.
That's not it. Let's try share. Stop the share.
If anybody has any questions, post them in the chat box. Again, we'll be available afterwards to talk, but I'm sure there's a lot of stuff coming down the pipe.
All right. I guess what we will do is try and pull this one up. Did that share?
No.
Of course not. How about now?
There you go.
Okay, so we've had a number of proposals floated, and I think that part of this was scare people so badly that they didn't care what happened when the ultimate proposal came out. So the federal exemptions were going to go down tremendously, all the way down to $3.5 million, and they never spoke whether there was going to be the retention of, and I'm going to use a term right out of a tax return, the DSUE, deceased spouse unused exemption, which means portability. As of this morning's proposal, the latest proposal, and remember, it is only a proposal. Every one of these things that have been floated could come back up in a conciliation meeting between the House and the Senate. So we have to still know about these things. But the portability allowed husband to not do any planning, and husband's exemption could be given to the wife if the wife survived them. And if the wife remarried and had another husband pass, they could get another deceased spouse unused exemption. And theoretically, it could multiply rather quickly. That is unknown whether we're going to still have this wait and see portability. Next, they had talked about decoupling the estate tax and the gift tax, floating that at $3.5 million for a person at their estate, that would be sufficient, and that they would limit the gifting to $1 million. If that happened, while you're making gifts and trying to save estate taxes, you're going to end up paying gift taxes, and that could be very expensive. Unclear exactly what would happen with the gift taxes paid, and if you had gift taxes paid between $3.5 and $1 million of threshold, would there have been any kind of exclusion transfer? Unknown. The $1 million gift threshold pointed directly towards everybody using as much of their gifting for leverage. and that would mean some of these GRATs and life insurance products. Going forward, they also had floated the elimination of step up in basis for inherited property, and that is in today's early morning release. It is going to allow for a $1 million for each individual. I mean, husband and wife could protect $2 million worth of capital gain when it transfers down to their children. Not clear again how it would work. That's going to be part of the technical corrections or the ultimate regulations. But they also added something new that we had not seen, that the $250,000 that each one of the spouses has in a personal residence, that's section 121A step, it was really just an elimination of capital gains. They're going to still allow that. And that would be allowing in total $2.5 million worth of capital gain elimination. Everything else would be taxed. All right. Then New York State, basically, we can just assume there's nothing that's been said, but Uncle Cuomo is not going to let the federal limit drop to a number that is lower than the New York State limit. So how far it drops is up to, it's up to the future New York State tax legislation. But up until 2014, April 1st of 2014, for almost 20 years, you had a $1 million threshold. Remember, New York State does not have an exemption from estate taxes. There is zero exemption. There is a threshold. If you have more assets than the threshold, you not only have to file a tax return, but you will pay tax on the first million and everything else. That's if it drops down to $1 million. If it drops down to 3.5 million, the same rule would apply. We just have to look at the ultimate numbers, but there is no portability in the New York State tax code. Next, New York State maximum rate. This is something that has been proposed. The maximum rate right now for an estate of $10 million or more is 16% for the New York State estate tax. They are planning on or hoping to enforce a 20% maximum rate. I really do expect that one to pass. New York State, as we all know, is also looking for revenue everywhere. Not only are they going to embrace more auditing of high net worth people and the like, they are also looking at sin taxes. Sports betting is one of the two that they have allowed, right? Under New York's new laws, betting will be allowed. They're going to tax it, and they're going to tax it with an additional tax, just like alcohol has a different tax for sales taxes and things like that. And marijuana, which we know just passed. The weird thing is that New York State and your 14-year-old kid are going to be looking for the same thing, the higher potency pot, because the higher the potency, the more the tax rates will be. So we actually have the government saying, we'll tax you more if you make better pot. So that is what was proposed and in the works up until this morning. I'm going to stop share and bring up a different screen. And let's.
So Larry, just because that last one was very interesting.
Yeah.
So that they're doing a tax based on THC content versus volume of product.
Yes.
That's different. Okay. Do other states do that also, or other states are just based on purchase of sale amount?
No, actually, it seems to be a unique feature of the New York proposal, and
Right. And on that, something just passed the House on cannabis. They passed a banking. They said that banking is okay. It's going to the Senate. And how does that affect our business? There are many carriers that won't insure people in the marijuana industry because of the banking and the tier 1 treatment. But if this banking passes through the federal, you're going to see the insurance companies follow the banking and start allowing insurance to be done on people and the distribution and whatnot of marijuana. By the way, we have many carriers that will accept marijuana users, as well as one carrier just said if you're using medical marijuana as opposed to opiates, they'll actually give you credits and you get a preferred underwriting with that carrier. Their rates aren't that high, but their philosophy is. Sorry, little joke.
Okay.
Go ahead.
In addition, part of the New York State plan, when they freed up the rules on marijuana, it's a nice way of putting it, was that they're going to go back over, I don't know if it's 15 or 20 years worth of convictions and basically wipe the slate clean. When you're underwriting for insurance, don't criminal convictions have something to do with your underwriting? So
Yes,
that should
absolutely.
also reduce the drag on getting people qualified for underwriting. Now, early this morning, again, 5 o'clock, the White House released its plan. The plan is very comprehensive, and I'm just going to see if I can show you what we're looking at. Okay, here we go. The All American Families Plan deals with many different things. It's going to deal with, the children's tax credits. It's going to deal with allowing for the government to pay for education. And when they're saying education, they're talking about 4 years of education. It starts off with 2 years of local or community-based education, post-grad, or excuse me, in college, and then all the way up to 4 years. You're going to have this free community college, then offer 2 years of community college and 2 years of potentially getting your bachelor's degree paid for by the government through extended Pell Grants, all kinds of things. And if you're lucky enough to be in a protected group, like the Dreamers, which were identified, I don't know if you can see here, right? Pell Grants are now going to be available to the Dreamers, which are, as most of you know, individuals who had some very difficult time getting American citizenship. They were brought here as minors. They did not have the proper documentation to come into the country. And in many cases, they have been denied all kinds of government benefits and loans based on the fact that although they were brought up their whole life here in America, they weren't a licensed or a citizen. Go through education preparation for teachers. They're going to expand all the benefits available to get higher education teaching done and bring it all the way down to the academics from K through 12. We go much further, provide support for children and their families. This is going to be credits, increase for child care credit. And for the tax preparers, that means that people who have more children are going to have lower taxes based on additional child care credits. Paid leave is going to be expanded. We're going to have some benefits for paying for people to have better nutrition for children in schools. Unemployment insurance reform. Well, if there was ever a program that needs reform, I don't know about you, but every person I've ever met has had a fraud in the unemployment insurance, right? I was told by New York State that I fired myself and that somebody at a different address applied for benefits. And I know hundreds of people who have seen that happen. So unemployment reform is going to be all kinds of from the inside and from the top down. Tax cuts for Americans with families, that's another program that's going to be referenced in from an earlier disclosure, but it's also designed to help children in families that have low income levels. Here we go. So now tax reforms. Okay. The idea is reform taxes that in such a way as will hurt the wealthy, right? Not. So now what we're looking at here is the new revitalize enforcement to make wealthy pay what they owe. So they're going to overfund a program of going after the high net worth people when they file their tax returns to audit them. This means that those accounting firms that do a lot of audit work, you're going to be doing a lot more. If you have high net worth people, you're going to be looking at a very high percentage of audits. So we're looking at people $1 million per year of income and over are probably 100% going to be audited. President proposal would also Same rules. Yeah, so it's going to be more financial information given to the government so that they can track the individuals to their tax returns, the investments to their tax returns. Now, the IRS, so I pinpointed that while they're increasing investments, the IRS is going to be watching them and watching for ensuring that additional resources go to enforcement against those with the highest income rather than Americans with actual income less than $400,000. What does that mean to the accountants out there? That means your clients who are filing with a $350,000 to $400,000 net worth are very unlikely to be audited. Yes, you can still be audited, especially if you have any of the triggering events like something like foreign income tax reporting or bank accounts outside the United States or being the beneficiary of a trust outside the United States. But other than that, the 400 and under are probably not going to be audited as highly as they were before. And remember, as highly as they were before was about 1% of the filers ever received an audit. Okay. Increase in the top rates on the wealthiest. So you see the 37 to 39.6 that we had discussed earlier, that is still in the proposal. Those are the top 1%. The rate cut alone gives couples with $2 million in taxable income $36,000. This is what happened in the 2017 Act. That is the Trump program. That is going to be reversed now, and even more than just reversed, it's going to be enforced at a higher level. You're going to see that there are certain families that have to pay the Medicaid tax, and they don't because of what they call loophole. They don't have to pay the extra 3-point-something%. Now the government is saying they're going to make sure that everybody pays it on all their income. The step up in basis. Here again, I highlighted this because this was in the proposals, and now here it shows up $1 million for each of husband and wife, and $2.5 million total per couple if they happen to own a home and if there's enough capital gains. And here's one of those things that that we weren't expecting, right? Here we go. Making sure, I guess I can't get it, but making sure that if you have a capital gain and you don't give those capital gain assets to charities, you're going to have to pay tax on the capital gains. So they are trying to push charitable planning. Next comes the elimination of the 1031 tax. They didn't completely eliminate it. And remember, nobody eliminated more of the 1031 exchanges than the Trump plan. Under the 2017 plan, I couldn't change an investment piece of artwork for another investment piece of artwork. It used to be that you could even go as far as, let's say I had a prize bull and I wanted to buy another one because mine's getting old. I could sell one and not pay the capital gain on that animal if they put it out to stud or whatever, and I would not have to pay capital gain on that. That 1031 exchange for livestock and other items like artwork and collectibles all disappeared in 2017. Now, President Biden would like to limit 1031s to $500,000 of gain that can be deferred. Which, let's say you happen to have a building in New York City. This is going to very significantly change your planning opportunities for how much property you can buy in exchange. I sell, I have to pay a tremendous amount of capital gains tax. And now I'm going to have to borrow again, or I'm going to have to do something of the sort of a reduction in the value of what I have to recognize that I just don't have the investments left after the tax. So this is a rather interesting piece of provision. I'm not sure exactly because they didn't actually say 1031 here, but it appears that's what it is. A reading of this might even tie into the section 1035, which would have. Yep, Daniel.
Just a couple of quick questions, one on the 1031 potential and one going back to capital gains. So is 1031 or this exchange effectively per property or per individual?
Well, it's an interesting thing, and it's going to end up being per individual per year. They're not going to allow you to break your 20-story building into 20 LLCs and then do $500,000 exempt transactions. So
Okay. So it's
there's
per,
nothing in this legislation that says that, but that's the only way this works.
And then going back to this capital gains for a quick second, I know that's a big topic of basically eliminating long-term capital gains for high income earners. Is it going by income or is it going by net worth at that point? Because I mean, I have clients that say have substantial assets, but they could basically make sure their income from their portfolio is under $1 million, or whatever the number needs to be to make sure that their capital gains stay at the kind of the 20% range. So I was curious if you think that it's going to be changed on just total income for the year versus, you know, assets that the individual has.
Yeah, my feeling is it's going to be income for the year, notwithstanding the capital, notwithstanding that individual capital gain, because it would be very difficult or almost impossible to have each person each year do a full net worth statement on every year, just in order to get it, just to get a reduction in capital gains, especially for multinational, really significantly wealthy people. It would be a very difficult task. So I think that reporting of income will be the trigger event.
Got it.
I
Okay.
haven't seen the legislation. All I've seen is these proposals, and as much as the proposals, look like they're very thorough, they are all scraping the very top of the equation, and just have to figure they're going to try and make it implementable.
Thank you.
Okay. So again, property gains. It says exchange property for gains greater than 500,000. And what I was looking at this morning, and I just don't see anything here in clarity, is that there is also a definition of property, and it includes life insurance policies. That's under the Internal Revenue Code 301880, whatever it is, the definition section. Notwithstanding that, if this turns out to be, in fact, what I think it is, then the 1035 exchanges may be, for the first time ever, at risk. And that's just something for us to watch and see. I don't see anything here. They're using the word property in, see it says exchange property, but it doesn't define this as exchange real property. And they didn't say 1031. Clearly, they could have said 1031. So it's up to the air whether or not that's going to apply.
Well, we see very few 1035 exchanges with gains of over 500,000. I have never seen one. How about that? I've seen some pretty big policies, but I haven't seen any 1035s of that great amount. So it may be a moot point.
Yeah, this may be an issue without resolve because it just doesn't apply. And then again, finally, high-income workers and investors generally pay 3.8% Medicare tax on their earnings, but the application is inconsistent across taxpayers due to holes in the law. Okay, the idea is now let's make it apply to everybody. Anyone making over 400,000 now looks like they're going to be paying that 3.8 tax. Surprisingly, that is a humongous increase in tax, and it's put down as the last sentence as if it was an afterthought. All right. So from our perspective, we still have to worry about a lot of these.
Right.
We still have to worry about a lot of these taxes being defined even more thoroughly. But for now, they seem to have pasted us with a lot of, I guess what you call is death by 1,000 cuts. There's a lot of little provisions. They all add up. All throughout this, with changes in the credits for child care and the rest, those are going to end up being paid somewhere. And
Right.
Don't be surprised when you see the tax rates going up for the middle class as a method. Right now, they're saying in this set of legislation, there will be no effect, really, no deleterious effect for the middle class. And this is designed to make the middle class have the same benefits that the wealthy do. That's Orwellian doublespeak for we will be raising taxes later, and it's just a matter of time.
So to recap, a lot of presentation, I know Peter had asked a question. Yes, charitable remainder trust is still a viable option, and maybe even more so with the capital gains and or charitable LLCs. Charitable gifting planning is very prevalent, and also with IRAs and, very prevalent. The time to plan is now. We're going to see a big boom in this industry, at least on my side. Of course, on the legal side, there's going to be a big boom in estate planning now that, things are going to be altered. And on the tax side, change always involves creativity and opportunity to help clients. And the biggest thing is, the takeaway today is, if you're not talking to your clients about planning now, they could be in a very bad situation in a couple of years. The time to plan is now. The time to think about products and trusts and everything else is now. And we have the tools here to help you in any of your planning, whether it be life insurance, long-term care, SLATs, life insurance trust, charitable remainder trusts, or in any of these premium financing, any of these areas that we can help you put your plans together. Just, rely on us to be there for you.
Okay. In closing, I just do one geek moment because I am what you call a tax nerd. So understand that if we go and act on what we know is the current law today, it causes problems at the end of the year. See, gift taxing is not measured at the date of the gift, but at the last day of the year of what the law and the exemptions are then existing. There's a code section 2505, which kind of says that if I make a gift today and I know I have $11.7 million worth of gift exclusion today, but they lower it to $1 million somewhere before the end of the year, we might be calling our malpractice carriers for the difference in those two numbers, because the tax could be a very huge gift tax caused by utilizing the gift exclusion and then having the law change. So what you must be doing is putting these escape hatches in. I know I mentioned it earlier, but the escape hatch is basically, I call it a Q-tip kickout, meaning that if it does create a tax by this gift, place any portion that would otherwise be taxable into a Q-tip or a qualified terminal trust, which terminal interest property trust, which really means marital trust. It goes all to the spouse and exempts it from taxation. So that's sort of the escape hatch we have to be looking at. And I'm just going to share screen so you see something about, this is me and my firm. Okay. We do wills, trust and estate, elder law, and business succession planning. And we're right here in Garden City, open for questions if you have any questions on this presentation or otherwise. And thank you for attending.
Thank you, Larry. Does anyone else have further questions? We tried to pull this all together within an hour, and we succeeded. I know there's a lot of information out there.
Larry, because there was no provision for SALT relief, is it a possibility this bill doesn't go anywhere, or this law doesn't get passed because there are Democrats in states like ours that wanted the SALT relief?
That is an excellent question, and I suspect that's something that's going to be put in for negotiation. I cannot see something passing without the SALT being restored for the big Democrat states. And if you look at it, those are the ones that have felt the most pain from the elimination of a SALT deduction.
Thanks.
Could you just repeat what you said about the escape hatch? It was always my impression that people were rushing to take advantage of the 7 million, do it right now, so it will be grandfathered in. You're saying not so fast. It won't be grandfathered in.
Yeah, there is a code section. I have not seen it enforced, but the code section is 2505, and it says that when we measure the gift is measured for fair market value and the date of gift, but the tax rate and exemptions apply as of the end of the year. And therefore, you need something to balance that short-term potential change in the law. So what I've been doing with my larger estates is throwing a Q-tip kick out, an escape hatch. And we do this all the time. Every one of my life insurance trusts say that if Section 2035 shall kick in, that's you gave up your last incidence of ownership less than 3 years. If that kicks in, put that policy or any proceeds that are otherwise taxable now, put them into a Q-tip. And we do that all the time in all of our life insurance trusts. So it's just expanding that same protection into larger gifts and SLATs in particular.
Okay, so you're talking about if the law gets implemented within this year, if you do this
That is
on
exactly what I'm talking about.
February, and then it changes between February and December.
Right.
That's the protection. That's the risk factor.
That is a risk. It is a very significant risk. As I've been telling people, if you're going to be doing these plans and you're not throwing those protection hatches, escape hatches in, you better be careful. At the end of the year, you might be contacting your malpractice carrier.
Okay, so and to avoid that, you could just implement these things at the end of December.
You put a formula in, basically. The formula says the maximum amount that I can retain of my lifetime gift exclusion, and if it should cause a gift tax to be paid, that is the limiting point. Everything else goes into a trust for the spouse alone. And what the way the SLATs generally work is my spouse and all of my kids can have the benefit of whatever is put into this trust. We just eliminate the children from being a potential beneficiary, and then you have a marital trust that qualifies under the 2056 marital deduction. Bing, you're done. You protected it.
Okay, but once December passes, subsequent years, it's not retroactive past.
That's correct.
Okay, that's what
Susan, we're in the what if business, and we're in the what if, what if, and that's what we're trying to protect, the what if. So yes, we can do it with insurance products, but we can totally insulate it with the combination of insurance and legal advice. And that's kind of what this webinar is all about, is we need to cover all the what ifs. And, can we blanketly cover every what if? No, we can do the best job we can possibly do with the resources we have today. And that's what we're trying to do.
And Susan, just so you understand, there is some sort of level of retroactivity to all legislation in the tax law. And that's because the government reserves the right to do something called a technical correction. That's where they explain what the law actually meant. It's up to you then to fight the technical correction, which is a clarification always in the government's favor. But that is rare, and I haven't seen a big technical correction package since the 1986 Tax Act. Okay.
Excellent.
Larry, and then remember, Larry, they've been issuing technical corrections on the 86 Act up until fairly recently.
Yeah.
Right. And now that the tax law changed at the end of 2017, they haven't even they've issued some things, but they got lots more to clarify on that too.
Absolutely.
So
and remember, for every single change we have here, New York State and the other states that your clients are acting in, they're making changes too, right? Not only are they making changes, but the cities have taxes and tax codes, and they're making those changes. I don't envy the practitioner who suddenly sees that all these laws changing at the same time. It's hard to stay up to date on it.
And did I see you have a specialty in expat?
I have, unfortunately, a long time ago, I spent 2 years, and I say unfortunately, it was a great 2 years, but I worked at KPMG in their international tax department. I had written a comparative study of Japanese and American tax codes and how they treat the Japanese purchase of American companies. And this is right after the stock market crashed in 1987, when the only economy in the world was Japan, the only one doing well. And so I worked on in the Japanese tax group, and we dealt with a lot of the expats. So Yeah, I have some background in it. I would not say that I am current on all the expat rules, but still have a pretty good.
He's a recovering CPA.
Yes, I am a recovering accountant. The day I passed the CPA exam, I started my law boards. All right. Any other questions? All right.
Thank you. Feel free to contact me or Larry. You're going to get a follow-up email with all this information. I'm sure that you're going to have more questions, as am I.
We're
After
going to get
tonight,
the slides from both of you?
Yeah.
or-
Yeah.
Absolutely.
you'll get the whole presentation. So we'll make it available to you.
His will be organized. Mine are just going to be in PDFs. I'm not so technical.
Thank you both.
Thank
very
you.
much.
Have a great day, everyone.
Have a great day.
Thanks,
Enjoy the
everybody.
sun,
Have a good day,
everybody.
everyone.
Thank you.
Bye-bye.
Good day for the tops to be down on your cars. So.
Mhm.